Hey, let's take a quick look at a couple of other companies here, just to kind of give you an idea. Some of the things that I look for, and some of the things that I would like to see reported on. I picked J&J. They were in the news this morning because they announced their earnings for the first quarter of this year, and the person that's doing J&J, you might want to take a look at that earnings report. And the reason is, and I even sent you a link to an article, but the reason is that it reported solid earnings, good earnings. J&J is a great company. We'll look at that, but it also had some worrisome reports about how the currencies are maybe going to affect its earnings, revenue and earnings into the future. And how does it do that? J&J, good all-American company, Johnson & Johnson, I think they have a couple of major things. I think they actually do some biotech or introduce new drugs and whatnot, but they also have this big portfolio of kind of consumer health-related products. I don't know if they do Band-Aids or something like that, but but they've got different health. I think they do some of the aspirins or Tylenols or whatever. So, and they've got a big portfolio of those types of things that provide a really steady income. Okay, it's really kind of nice, but they're concerned about currency, and why is that a concern? Well, it's obviously a concern if you're making things here and you're exporting them. And what's happening is that the U.S. dollar is becoming stronger versus foreign currencies. Our economy seems to be slowly perking up a little bit, really slowly. It's really not good at all, but as compared to the rest of the world, it's really nice, I guess. And partly as a result of that, and some other things, without getting into something I could probably spend a semester talking about, the dollar's getting stronger, and so you can imagine if you were an exporter, and I don't know if J&J does a lot of exporting, we'll see, but if you were an exporter, all of a sudden, if our dollar's strong and you're producing things at that strong dollar and you're sending them over to another country whose currency is weak against the dollar, it means that they're going to have to pay more for our product, and thus they might not buy it. Okay. The other reason is this. Let's say that you don't necessarily export, but you just sell products. Maybe you have them manufactured in Bangladesh or something, and then you're selling them in Europe. And the problem is that the dollar, just even a few weeks ago or a couple months ago, anyhow, the 1 euro was worth about $1.20. Okay, so if you sold a euro's worth of stuff, if you're J&J and you sold a euro's worth of stuff in Europe, okay, when you converted that, you'd have $1.10. Okay, now the euro's worth like $1.10. So you sell that same, do the conversion, you only have $1.10, and so it has a big effect on some of these multinationals and need to analyze a little bit, because it is an absolutely stellar company in terms of its balance sheet, in terms of its record and whatnot. But let's see if we can find a couple things. One thing that you'd be remiss if you didn't comment on is this, and it shows up down here, is Morningstar credit rating. As my computer kind of clogs up again here, I'm sorry, but its Morningstar credit rating is AAA. Okay, AAA is as good as it gets. If I'm not mistaken, there's only literally a handful of companies in the whole world that have a AAA rating. Okay, and so J&J is one of 4 or 5, I think, companies in the whole world. I'm not even sure Apple has a AAA rating. Be interesting. We'll go take a look maybe if we have time and if my computer decides to work. But so where do we go then? What do you say? When I'm telling you, look for oddball things, that this company might have gone through. And by the way, as I'm doing this, I'm going to tell you some things not to do, some things that are almost like guaranteed to ensure you a D for this paper. Okay, let's take a look. I'm clicking here. You know, I've gone up. I love this line here because there's such cool stuff on here. But I clicked on the financials, and hopefully it'll get us to look at the financials so that we can take a peek at what's going on with GE. Or J&J, I'm sorry, I called it GE. GE's been in the news too because they're spinning off their financial company, part of it anyhow. So here we go, J&J financials, maybe. Okay, yeah, so what things do I look at? And again, here's a company that's doing really well. Okay, and so this is recent. This is the trailing 12 months, which it looks like this is just year end, so it's the same as 2014. So they must not have updated. They just came out with their quarterly report, so that's not surprising. So these two are identical. So, but if we look at the year end for 2014, right, we had, you know, cost of revenue. Man, that stayed pretty close. You know, and so gross profit obviously then has stayed pretty close. Sales in general and administrative, you know, that might be worth looking at because look at this from 2011 to 2014, it's dropped almost 3%. 3% is huge, right? 3% is a huge number. Okay. Other operating expenses, yeah, you know, 2012, you might have to take a look at that, and you might have to take a look in 2013 because, well, again, it's a percent 1.73 and 0.81. It's not a lot. Look at the difference that we get when we get down here to the operating income. We go from 23.6 all the way in 2012 up to 28% in 2014. That's an increase of almost 5%. Well, you know, if you're selling $100 billion worth of stuff, that's a lot of money. Okay, and so those are the things that you need to look at. You can see that affects down here with the income taxes. Okay, the thing here that I want you to look at, who's ever doing J&J, but another thing for others to look at is that 2013, 12, and 11. Look at that, other expenses. And again, those were huge. Okay, so we went from in 2011 a 19% return or income before taxes. This would be my ROE actually, right? I'm sorry. This would be my ROE because we got to have the tax provision. But we went an income before taxes from 19% up to 27%. I mean, that's a 8.5% increase. That's huge. After taxes, it's still about 7%. It's a little over 7%. Huge, huge, huge. We're talking about a company that sells. Let's change this to dollars, and then we can take a look. If it'll change to dollars, you can do that easily right here. Maybe you can do it easily. You guys can do it easily if your computer works well for you. If you don't have BB flashback in the background that's taking up time. Hopefully it's going to switch to dollars. There we go. Okay, I lied. They don't sell 100 billion. They only sell $74 billion. Nice increase. You know, look at that revenue though. But anyhow, so 74 billion. You know, and you can't say that all of it's been based on 74 billion because it's grown from 65 to 74 billion. But so you've got both increasing percentages when we looked at these gross profits, not so much the gross profits, but you looked at decreasing expenses, which gave you a huge increasing operating income percent. Okay, you didn't have these other expenses, which I gotta know what those were, right? Somebody needs to tell me. Okay, and so we went from a profit then. Now look at that, we had a big downturn in 2010 to 2011, but we went from 9.67 or 9.7 billion roughly up to 16 billion. You know, that ain't far from doubling. I mean, that's sweet. You know, on an earnings per share from 354 to 580 per share. Their shares are pretty. Yeah, it's always nice to kind of look at that. But their shares are pretty even, so they're not. They're probably not buying back stock. They're probably not issuing stock. They're probably doing a little bit of stuff with some employee stock ownership types of things, or stock options, etc. So those are some things to look at for a great company like J&J. What an awesome company, and there's more. You should take a look at their bond again. it breaks down their ownership and their capital allocation. And here we go. If it comes up, this is such a nice little view. It tells you both historical and what it is today. You know, again, AAA outstanding. They've only got $15.2 billion of debt outstanding. For a company this size, that's not that much. Book value, you know, their equity is about $69.8 billion. Their debts, it says here, about $18.8 billion. This is probably then debt that's outstanding in bonds. They've got a certain amount of other debt that's probably accounts payable, those types of things. I'm guessing that makes up the difference there. Okay. That's kind of interesting why we got the two different things here. Type and debt. This is historical. Oh, okay, that's just the year. There we go. I'm sorry. So you can cover over those, and it changes then from year to year what they have for debts and those types of things. So, but again, AAA. So not everybody's J&J. J&J, out of all the companies that you guys put, Apple might be. We might, if we get a chance, to take a look. But J&J is probably one of the only AAA rated companies that we're going to take a look at. I mean, it's an impressive company, and so y'all should take a look at that. Note the structure. You know, 21.2% is debt, and 78.8%. And if you hover over it, you know, it's actually gone up. So their debt's gone up a little bit. You might want to mention that. This was September of 14, though. You know, December, so from December of 13, they went from 19.7 up to 21.2. That might be simply, again, it could be a seasonal thing, accounts payable, those types of things. It's good to look at. Okay, so let's move on then and go to, let's pick a company then that's maybe not doing so well. Okay, and how do you analyze that? Well, let's take a look at Barnes & Noble. Is there two people that picked Barnes & Noble? I don't know why. Barnes & Noble. Barnes & Noble is struggling. Okay? And probably for all the reasons you might expect. You know, books, people just don't go to bookstores so much anymore. And I don't know if they've revamped themselves. You know, it's got a market cap of $1.5 billion. They don't pay a dividend. They're still selling at a fairly high price to earnings ratio, price to book, price to sales. You'd have to compare that, and I don't know if they have comparables. You know, their competitors have probably, you know, you got Amazon, and then you got others here that it's tough, right? Because not too many people still have brick and mortar types of stores, and then still have the online thing. Okay, at least not public ones. There's probably still a ton of little mom and pop bookstores around, but probably not that many, you know, that tried to go big like Barnes & Noble did. And they sell the Nook, but I don't think the Nook's done real well, and so this is a struggling company. And we can probably see that just as we come down here, right? Price to earnings, that's different than what we saw above, but price to books way lower, you know. Just probably not all that good in terms of stuff. Revenue, 2012, steady decrease, right? Look at that. They did improve their operating income, and even though their net income is still negative, it's less negative than it was before. Okay, so there's lots to talk about here when it comes to Barnes & Noble, and again, probably telling me the why of it. And let's go take a look at their financials. What do you suppose they're rated? Yeah, I'm going to take a look at their percentages because these things are important, right? They've gone from 74% cost of revenue down to a 69%, you know, in the trailing 12 months, 70% there. So they've gotten their cost of revenue down a little bit. That's a good thing. Increased their gross profit. Okay, this is why their income was less negative, be the proper way to put that, I guess. Sales and general administrative expenses, though, you know, so they took the gains there that they had there and they spent them in sales, general, administrative expenses, and so now all of a sudden their total operating expenses have gone up, and their operating income just a smidge better than it had been. got some interest expense, not a lot, so it doesn't look like they've got a lot of debt. That might be saving their butt a little bit. Provision for income tax, that kind of puts them negative. They had income before income tax, provision for income tax, which actually puts them negative. That's kind of interesting. You might want to tell me about that, right? Because if you're only making X dollars, why do you got to pay so much in income tax? And that's hard to say. You might have to tell me that. Whoever's doing Barnes & Noble, I might be interested in knowing that, right? Okay. Earnings per share, mixed bag, horrible. From 2010, they actually made money, and they've lost money for 4 years in a row. So you might want to tell me about burn rate, okay? And by that, and this is a company where we might want to look at the balance sheet in particular and see where they're at. I'm going to put balance sheet. I kind of like to look at in terms of dollars. They've actually increased their cash quite a bit, but I wonder how they've done that. And they've been working on decreasing inventory, but their current assets are about the same. So they've decreased inventory, increased cash. Those are some pretty good things. They got some deferred income taxes. Prepaid expenses, I'm just looking at fixtures, land, so they're fixtures, but lots of accumulated depreciation. So that's coming down significantly, but it looks like they're not building anymore, and they're just depreciating the stuff that they had. I mean, that looks like a pretty consistent fall in overall property, plant, and equipment. Okay, intangible assets, that they probably have some patent rights for the Nook and those types of things, maybe. Total assets, they got some long-term liabilities, and those have been increasing. Okay, that's a little bit worrisome, and I would like to, I guess, know about that a little bit. Okay, what's going on there? Their retained earnings account's been decreasing, right? Okay, and so their total stockholders' equity has been decreasing right along. So, can they turn this around? Wow, that's the speculation. Okay, so you might, as somebody that's doing Barnes & Noble, take a look at the balance sheet, because there's some worrisome things on there, and you might want to tell me about them. Why did their short-term debt go up to 127 all of a sudden there? Okay, they've been reducing their accounts payable. That's probably consistent with their reduction in inventory, is my guess. So not a lot there to really talk about. But other long-term liabilities, it's doubled there in 4 years. And so you better tell me who's financing them, okay? That makes me a little bit nervous. I come over and see if they're issuing bonds and see what they're rated. My guess is if they're rated, they're probably a junk bond. It has no bond data, so they're not getting their financing from bonds. Okay. I'm going to go back here. I want to look at the quote. I want to see if Morningstar does have even a rating on them. Because they might not if they're not issuing bonds. Yeah, Morningstar credit rating doesn't show anything. So they're not issuing bonds, so they're not getting any rating on those. So whoever's doing Barnes & Noble, you probably want to tell me where they're getting their financing from. Okay, because they borrowed $1 million or $1 billion something from somebody in long-term debt. The short-term stuff is probably accounts payable, those types of things. Those just kind of go with the flow, but that long-term debt's really kind of worrisome. And so you certainly want to tell me about that. Okay, take a look at some more of this stuff. You got two companies when you switch from J&J to Barnes & Nobles that are going different directions, and for all kinds of different reasons. Barnes & Nobles is kind of partly their fault, maybe for not being able to figure out how to retool or redesign their company to make it current and still exciting. But also because that whole industry's changing. Just like the people that make CDs, right? The compact discs that nobody listens to anymore, they're probably going broke too. Or the old video rental stores, right? Nobody does that anymore, so kind of going by the wayside. So there's a couple more companies. I think I'll quit now so I don't get too lengthy here.